So that's our discussion of annuities. We talked about their tax consequences in another section. We still have one more insurance-related topic within here, and that is life insurance. So we have the ability with our Series 6 license to sell variable life. So variable life is a type of whole life. So when we have whole life insurance, it's insurance that covers us for our whole life until we die, or for simplicity's sake, we're going to say until age 100. Whole life matures at age 100. Granted, sometimes today you might find whole life policies that go to 110 because we are living longer than we used to historically, but it's kind of been a basis of understanding that whole life protects you until age 100 for many, many years. So we're going to leave it at that. When we have our insurance license, we can sell traditional whole life. Traditional whole life is just an insurance product. It has a fixed premium, and it is, of course, life insurance. It's protection. And the money goes into the insurance company's general account where you are guaranteed to earn a minimum interest rate. So just like a fixed annuity, the insurance company has the risk in the general account. There's a minimum interest rate. This is protection, it's insurance. So you pass a physical to purchase it. When you die, the face amount is paid to your beneficiary tax-free. Both of these policies have cash value, both variable life and traditional whole life. It's just that what exactly the cash value is going to be on a traditional whole life policy is known in advance because the cash value is comprised of two things: a fixed premium and a fixed interest rate. So it's 3% or 2% or whatever the insurance company has promised to pay. Anytime we have a positive cash value, we can take out a loan out of a life insurance policy. What's paid when we die is face amount minus loan plus interest. So traditional whole life, they are kind of expensive policies. Variable life is going to be slightly less expensive because there's no guaranteed interest rate. In a variable life insurance product, it's regulated not only by the SEC but also by the state. You have to give out a prospectus whenever you sell variable life. What's variable is the rate of return in the separate account. The rate of return in the separate account is what is variable. The least amount that's paid when you die with variable life is the face amount, and the premium is fixed. The premium is usually a little bit less expensive on a variable life policy than what you would see in traditional whole life. But the whole benefit of variable life is if the separate account does well, it's possible that more than your face amount is paid when you die. Face amount plus what we call the variable insurance amount. But never less than your face amount can get paid when you die. So both traditional whole life and variable life have fixed premiums. Which one has a guaranteed interest rate? Traditional whole life. Variable life has a variable interest rate. Which one can pay more than the face amount upon your death? Variable life. Life insurance death benefits are always tax-free to the beneficiary. If you own the life insurance on your own life, those life insurance face amounts are included in your taxable estate upon your death. We know exactly what the cash value is going to be in advance on a traditional whole life policy. We do not know what the cash value is going to be in a variable life insurance policy. There is no guaranteed rate of return. But your cash value is never going to go below zero in a variable product. Even in a variable life insurance product, the investment objective is not super risky. It's somewhat conservative: long-term growth, preservation of capital. When you're in a variable life insurance policy, it's the insured that has the risk as it's related to the rate of return in the separate account. It's still life insurance, so there's always that minimum death benefit guarantee. Charges and expenses that are deducted by the insurance company from the gross premium collected include the sales load or commission, so it's kind of talking about that with an annuity. The largest expense of the separate account include the mortality expense, administrative expense, the management fee, that's always the largest expense. There's the cost of insurance protection, because this is an insurance product after all. How much is paid when you die in a variable product? Well, the least that's paid is your face amount plus a variable insurance amount. So generally what's going to happen is that annually the insurance company has to send you a statement of what is your variable insurance amount. So it's kind of a funny concept. What they do is they look at your cash value and see if there's more than enough in there to provide your death benefit. They take the extra and they use it to buy you life insurance based upon your age, your gender, at the time that they put together this account evaluation, if you will. Granted, you didn't die that day, but $5,000, if that's the extra cash value, is going to go buy a whole lot more insurance on a 30-year-old than it's going to buy on a 60-year-old. So that's the variable insurance amount. So that's how variable life insurance works. It pays out the face amount plus, if any, the variable insurance amount, which is basically whatever extra in cash value is in there used to buy insurance on a dead person. I know, it sounds so weird. But it does matter your age, it does matter your gender at the time of your death, how far the variable insurance amount will go. And remember, death benefits are tax-free to the beneficiary. We have an AIR, of course, which is very conservatively set. It's never a guarantee of anything. If the separate account experiences returns that are greater than the AIR, then there are additional funds available to contract holders. That increase in death benefit will occur. The least that's paid when you die is the face amount. So it's this interesting concept when you have a cash value policy that you can access some of the earnings in the form of a loan, and it's not taxable. Loans are not taxable. What's paid when you die, face amount minus loan, plus interest, of course, on your loan. If you were to take out a loan out of your variable product, out of your variable life insurance, so when you have variable life insurance, you have your cash value in the separate account. And let's say you take out a $10,000 loan. The insurance company actually gives you their own $10,000, but they're going to take of your cash value, let's say your cash value was $85,000. They're going to take the $10,000 and they're going to move it into the insurance company's general account during the term in which your loan is outstanding. So if the separate account earns 12% and the general account only earns 3%, during the period of time in which your loan is outstanding, you have an adversely affected interest rate. That's okay. I mean, you don't have to pay off your loan. If you were to choose to pay off your loan, then the money would slowly go back into the separate account. But you're never going to be able to make up for the time in which your loan was outstanding. So, and that's just done to protect the insurance company. The money that they gave you was actually their money, and then they're keeping your money safe in the general account as collateral for the loan. Variable universal life insurance, a VUL policy. You'd also have to have a securities license in order to sell a 6 or 7 variable universal life. A variable universal life policy has 2 different death benefit options. Death benefit option A is term insurance, and then death benefit option B costs extra. It's term insurance plus cash value. So variable universal life allows the client to self-direct funds within the separate account. So it's this idea that within the family of funds, the client can choose to self-direct funds. How do they want this money invested? It's, of course, in the separate account. No guaranteed interest rate. No guaranteed interest rate. So variable universal life, they sometimes use the term, it has a flexible premium because the face amount is term. So if you had a $100,000 term insurance death benefit, so this was your face amount, so long as this premium is paid, you have your full amount of protection. So if you want to take out money out of your cash value and use it to pay your premiums, you can. It will never change your face amount. If you paid for death benefit option B, what's paid when you die, the face amount, $100,000 in this case, plus whatever's in your cash value account. And you, the client, chose how to self-direct funds. So remember, when we talked about traditional whole life and variable life, we had a fixed premium. It stayed the same. It never changed. But variable universal life, they like this idea that it has a flexible premium. Universal life just by itself was invented in the early 80s when interest rates were really high, so that it functioned in a similar manner to the variable universal life policy, but it had a current rate in the cash value, and it was not a securities. It is not a securities product. It also has 2 death benefit options. But in order to sell variable universal life, you must have a Series 6 license. It's true when you sell a variable life insurance policy, you have to give out a prospectus. There's one that's given out at the life insurance contract level and another prospectus given out related to the separate account. So there's actually kind of like a contractual plan had 2 prospectuses. When you sell variable products, variable life insurance or variable annuities, you have to give out 2 prospectuses as well. One at the contract level and one at the separate account level. Variable life insurance has a higher level of risk for the insured than traditional whole life does. So we have to allow the client the right to exchange from a variable product into traditional whole life, regardless of health, without having to pass a physical, regardless of health, for a period of time that is no less than 2 years, that is no less than 24 months. No less than. So they can chicken out of their variable product and no matter their health, get into a traditional whole life product, no matter their health. If the contract is exchanged, the new whole life insurance policy will have the same contract date and death benefit as the minimum guaranteed in the variable life insurance policy. Premiums will equal amounts guaranteed in the whole life insurance contract as if it were the original contract. Usually the premiums are more expensive in traditional whole life because it has that minimum guaranteed interest rate. The whole life insurance policy exchange for the variable life contract will have a cash value equal to the amount stated in the table of guaranteed cash value for the period the variable life insurance contract was in force. So we will go, generally speaking, from the riskier product, which is the variable product, to the traditional whole life. How long do they have to let you do that? 2 years. We know that these variable products are insurance products and securities, so regulated by the SEC as well as by the state. We need to disclose all of the risks, give out the appropriate prospectuses, of course. Variable life is a security. You must be registered as a Series 6 or Series 7 licensed person, registered rep. You have to be registered with state authorities as well. The company issuing the variable life contract must also be registered, yes. We talked about sales charges must be reasonable, right? We have this rule for variable products and the sales charges, this reasonable standard. Historically, we had a rule that said it was set up like that contractual plan. So just to review the contractual plan rule. If it's a contractual plan set up as a front-end load, what's the maximum sales charge the first year? 50% spread load in any 1 year, 20% first 4 years, 16% not to exceed what over the life of the contract? 9. So that's true historically, but today for variable products we have a reasonable standard. The insurer is required to extend a free look to a variable contract holder for 45 days from the execution of the application or from 10 days from the time of policy delivery, whichever is longer. whichever is longer. So that kind of goes back to what we had on the contractual plan, which was a 45-day free look. So free look, 45 days from policy application or 10 days from policy delivery, whichever is longer. So if the policy application was taken today and delivered 6 months from now, then it's 10 days from policy delivery. Whichever is longer. During the free look, the contract holder may terminate the policy and receive all monies paid. So they get back whatever they had put in during the free look. Additional refund provisions extend for 2 years from the issuance of the policy. If within the 2-year period the contract holder terminates participation in the contract, the insurer must refund the cash value, which is true anytime you want out of a policy that has cash value. You take what's called cash surrender. So if you're in the first 2 years, you get your cash value plus all sales charges deducted in excess of 30% the first year and 10% the second year. After the 2-year period is over and you want out of your life insurance, all you get is cash value. So those are the additional refund provisions of a variable life insurance contract if someone should take cash surrender during the first 2 years. The last concept that we have in this section is a FINRA notice to members about something called life settlements. So the test is interesting. Sometimes things appear on the test where we aren't 100% sure how or why they showed up there because they're not on the outline, but people have seen them, so we talk about them. This is kind of one of those topics. Today, if I had to bet money, I'm going to say it's probably not on the test. Life settlements, why? A life settlement involves a person who has life insurance on their own life, who sells their owner's rights for more than their cash value but less than their face amount. And what has happened over the past few years is that several states have outlawed this practice. So originally the practice was born out of what's called the viatical settlement industry, which was born in the early 70s. People had terminal illnesses. AIDS was one of the big things going on at the time, into the 80s, early 80s as well, where people needed money because they were really sick. So a viatical settlement was when someone that was terminally ill sold their owner's rights because they really needed the money to get better, okay? So viatical settlements are still perfectly legal. They're allowed. State laws, of course, have to be followed if you're going to be involved in a viatical settlement for your client. The key to a viatical settlement is that your client is terminally ill. So a life settlement kind of was born out of the viatical settlements industry. So I've done a lot of various discussions with people about this concept. When you buy insurance, right, you buy insurance to protect, generally speaking, your family. And you want to have money there in case you should die tomorrow, right? So there's different kinds of life insurance needs that can be met, but the ultimate point is to provide for your family. And you name a beneficiary, and 99% of the time, that person that you named beneficiary loves you and hopes that you live, right? They don't hope that you die. So it's this concept of insurable interest. If you sell your owner's rights to an investor for more than your cash value but less than your face amount, how does the investor maximize their return on their investment? Hope and pray you die soon. And that fundamentally violates this rule about why insurance was invented in the first place, which is to protect families, for protection. What about your family if you were to die tomorrow? So because so many different states have outlawed the practice of life settlements, I highly doubt that it would be on your test today. But just in case it was, there's a few key points that I need to make. You can read the full notice to members. I'm not going to read the whole thing to you. But it's this idea that if you recommend this to your client, FINRA Rule 2111 is the suitability rule. It must be suitable for your client. Of course, you can't be violating state law in so doing. You must conduct due diligence, making sure that you're following any state laws that allow you to engage in a life settlement practice. You need to follow best execution rules, which is FINRA Rule 5310. It's just this idea that you have to get the best price that you can for your client. So generally speaking, that means you get multiple bids from different life settlement providers. Training and supervision, NASD Rule 3010, says that your firm must train you to follow the appropriate rules. And in many states, this practice is not allowed anymore at all. Compensation in connection with variable insurance contracts is the rule about how can you get paid outside of your normal course of business. So probably not a big emphasis on that today. The whole thing's in there though for you, so I would be sure that you read it. This is a hugely important section on this test. I know you can do it. You want to ace it. It's the big one, right? Read your key facts. Practice your quiz. If there's anything that you're confused about, you know how to reach us. Just send us an email. Have fun.